Welcome back. Today, lesson 6, covering chapter 11 and 12. Chapter 11 presents capital investments. The material is divided into 7 subjects as listed here. Number 1, stages of capital budgeting. Number 2, discounted cash flow evaluation. Number 3, payback method. Number 4, accrual accounting rate of return method. Number 5, relevant cash flows. Number 6, project management and performance analysis. And number 7, strategic considerations in capital budgeting. Let's talk about what capital budgeting is. It is a process by which the firms evaluate long-term investments. This evaluation follows a familiar 5-step budgeting process. Number 1, identify the projects that agree with the firm's long-term strategy. If it's not in the strategy of the firm, we want to look at, should we consider changing the strategy of the firm to accommodate the opportunity. This is not always a good idea, but occasionally can be. Number 2, gather information from all parts of the value chain to evaluate alternative projects. Number 3, make predictions using potential cash flows attributable to all of the alternatives. Number 4, make decisions by choosing among those alternatives. And number 5, implement the decision, evaluate the performance, and learn. The most useful tools of evaluation utilize the time value of money concept. The net present value approach adjusts all future cash inflows and outflows to a present value that allows us to visualize and organize the information in a systematic way. We first sketch the relevant cash flows. Next, we use the tables or a financial calculator or spreadsheet program to discount these cash flows. That is, the further out in the future the cash flow is, the less its present value will be. Lastly, we make the project decision based on calculated net present value. In this particular type of analysis, if the present value is greater than 0, that's a recommendation to pursue the project. A similar method is termed the internal rate of return. Here we set the target rate of return and set the net present value to 0. So rather than starting with a given interest rate, we start with a 0 present value, and this will yield then the annual rate of return for the project that can be compared with the required rate of return on the project. That is, what the firm is expected to make versus what they feel that they must make in order to be profitable. Since both of these methods involve forecasting rates and flows, rates of interest and flows of cash, we can sharpen our analysis by using sensitivity analysis. In economics, this is called marginal analysis. This is done by evaluating alternative estimates and doing so with each of the inputs and observe the effect on the value. So we look at relative percentage rates of change for all of our inputs and our valuation to discover which are the key factors influencing that profitability projection the most. A third method is to measure the time it will take to recoup the net investment of a project using expected future cash flows. This method does not incorporate the time value of money and therefore tends to overstate the value of the cash flow returns. Nevertheless, it is useful when used in conjunction with the first 2 methods. The categories of cash flow fall into 3 categories: initial outlays, after-tax cash flows from operations, and cash from disposal of assets and recovery of working capital at the end of the project. These are analyzed at length, pages 458 to 461, and we will go into that in class in some detail. Here in outlining it, it's a bit much. Post-investment analysis and performance evaluation is an important final step in the process. Here we learn to improve the budgeting and management of projects. The chapter closes with some thoughts on investment in research and development and on customer value creation. Next, in Chapter 12, we introduce the master budget and discuss responsibility accounting. A budget is defined as a quantitative expression of a company's strategy and action plans. The master budget flows from and is influenced by the firm's operating and financing decisions on how to use scarce resources. A well thought out budget can accomplish several goals. First, promoting coordination and communication between different units of the organization. Second, providing framework for judgment performance. And third, motivation of managers and other employees. The budget process is both expensive and time-consuming, and I can tell you, not much fun. Senior managers spend 10 to 20% of their time on budgeting, and the finance department will spend up to 50% of their time on it. Exhibit 12-2 presents a flow chart that details the process of generating a master budget using inputs from all parts of the organization. Note that every master budget starts with a projection of revenues or sales or income for the year or for the time period involved, and then develops the other parts of that budget in light of that basic fact. Budgets coupled with responsibility accounting provide feedback to top management about management centers. Organizational structure of an organizational structure refers to the management of lines of responsibility within a firm. This can be done using business function, product line, or geographic unit. Responsibility centers measure the plans, budgets, actions, and results of each center. There are 4 types discussed: the cost center, the revenue center, the profit center, and the investment center. Feedback about these centers is provided by looking at budgeting coupled with responsibility accounting. Differences between actual results and budgeted results, called variances, help in planning strategy 3 different ways. Number 1, variances provide an early warning. Number 2, performance evaluations are going to be influenced by variances if and when the manager has actual control over that variance. To be evaluated for something over which one has no control is unfair, counterproductive, and will result in resentment on the part of your middle management. And finally, the evaluation of the strategy of the firm can be accomplished by examining these variances. The chapter closes with controllability and responsibility, 2 very important issues that are linked, as I indicated earlier. With great control comes great responsibility, to paraphrase Spider-Man. We also take a look at what's called budgetary slack, the practice of building in a certain amount of margin into our budgets so that we don't run over them, but it is unrealistic and leads to wasteful practices. We also talk about stretch targets. And finally, Kaizen budgeting. The Kaizen is a Japanese term. We'll look somewhat at that because one of the discussion questions deals very directly with that issue. Note that there is a problem set of problems to be completed with Chapter 11 and Chapter 12. With Chapter 11, there are 3 problems, 22, 23, and 27. With Chapter 12, it's 18, 23, and 24. These are contained in your syllabus. Make sure that you're not overlooking these because they represent part of the responsibility for homework for the course that you're very close to finishing now that we have completed Lesson 6. We'll see you next week. Looking forward to our meeting on Monday of this week.